So we're talking about navigating one new law, LLCs, and some side points. The agenda is basically fundamentals of an LLC, tax matters, Prop 19, and a Prop 19 workaround, Corporate Transparency Act, some case studies, and how we can help. So here's all of our attorneys. We're a good bunch, in my opinion, of counsel. And here's our entire staff with attorneys. So we're a family atmosphere here, in truth. A lot of caring between all these people. And between all these people and clients is something very important for you to know. We treat you like family also. Here's quick pics of our 8 offices all around California. And now to the meat of the matter, fundamentals of an LLC. But very first, I want to step back to talk about the other comparisons. So you could use a partnership to house your business or your rental property. There's 2 kinds. One's a general partnership, which is not mentioned here because it's really outdated. It offers no unlimited liability, and everyone has unlimited liability. So partnerships, though, are very good for real property, very good tax law. And so that is a very good choice for a multi-member LLC, not the single member. More soon on that topic. An S corporation, that's a sub-chapter S corporation, is really the entity of choice often for an operating business. It's not heavy in real estate. You can minimize the 15% employment tax, and you can increase deductions by renting business property from your revocable trust to the corporation and creating a deduction there, business deduction. And then finally, the other remaining option is a regular old C corporation, big caveat there of double taxation. That's something, sorry, we went forward early. That's something that you really don't want to use, except for in very, very limited circumstances, unless you're a huge corporation, because the taxes incurred both at the corporate level when it receives income, incurs deductions, and at your level when you receive that income as dividends. So with our tax rate structure these days, that's really a no-go. So here's the heart of our matter, really. A limited liability company is an excellent shield against liability for against creditors, matters that you incur as part of your business and are discussing for one reason or another, but haven't yet paid, and a protection from liability against litigants. That can include a creditor or often a slip and fall injured person. So insurance salesmen have a line. They say, insurance can limit your exposure, your liability exposure a lot. And it's true. But I say, why be exposed at all now that we have this wonderful entity that really doesn't have downsides outside of a small annual fee to the state? While I've mentioned that, though, I'm going to tell you it's $800 every year in California, plus a $20 every 2-year fee to the Secretary of State. So some examples of who should consider using an LLC: rental property landlords, as I've said. I wanted to throw in here, a client recently, husband and wife, recently told us about a lawsuit they've been in that was brought by one of their tenants. Have a lot of rental property, and the judge literally never allowed them to speak in the courtroom. He only emphasized what the tenant was saying, and our clients say there's lots of lies in there. So very, very sad case of not having timely obtained an LLC. Business owners can also benefit from LLCs, as can licensed professionals, consultants of any kind, and independent contractors. So consultants are often independent contractors, and what you're protecting, what everyone stands to protect in an LLC, is their nest egg, all of their other assets. That they are especially important, in my opinion, is the retirement assets. You've worked hard to get those, and you don't want them to be subject to a lawsuit. An LLC prevents that in all but the very most egregious cases. So you can protect your consulting work. You can form the entity as an LLC and then elect subchapter S taxation so that you can save that 15% in employment tax. So timing on forming, of course, most people learn this in hindsight, but before there's an accident or a lawsuit filed. And in addition, before you purchase a new rental property. More about that later. So the advantages of LLCs are, well, I couldn't help but tell you earlier that they protect your nest egg. But the thing is, they protect your nest egg as well as a corporation. And you don't have the hassle of annual minutes being required as corps do. As an aside, we form LLCs in all states. Some states have no income tax, which is wonderful. And Nevada arguably maybe offers better protection than California, but it's minuscule. So for forming an LLC, an attorney is critical for a couple of reasons. The operating agreement is what sets forth all of your plans and management provisions for going forward. Non-attorneys can give you, well, offline, you can get a standard packaged operating agreement, but it doesn't in any way consider your specific needs. And then deeds. Deeds are done by attorneys if you want them to be done right and not have to fight with the recorder or assessor later. And it's the ancillary documents also that are critical in making sure that property tax is considered and handled accurately. Really, attorneys only use organizational minutes. Create organizational minutes. And that is if desired, if you want to have a record of what the plan is. Sometimes it's nice to have that in your record book as what was intended going forward. And then another area in which attorneys excel is buy-sell agreements. These are way more important than most understand. This is to protect your day-to-day and long-term operations when something changes from how it originally was planned. And BTW, things will change. So specifically, the changes that are commonly protected in a buy-sell agreement is when one member wants out or a member becomes disabled. What will you do then? It's so very good to have this agreed in advance when everything's friendly, there's no time rush, and you can be wise as opposed to having to negotiate perhaps with someone who's very eager to sell out? And then most importantly, what will be done with member interests when a member dies? Very much better to agree on those buyout terms now, how their interest will be valued. Make that very simple, but it's in writing and agreed by all parties. Don't want to have to agree on this when you're in a crisis. And for a death, excuse me, I got mouse happy. The final bullet is all the members should strongly consider purchasing life insurance while it's cheap at a younger age. And that can be used to fund buying out a decedent member's family. So again, I like to repeat these important things. If you own a rental property, there's a definite risk of litigation claims. Excuse me. Courts have become increasingly aggressive against landlords. Don't think those are just words. It is the dead-on truth. Excuse me. Got an allergy cough. And tenants and their friends will look to your deeper pockets if there's a serious injury to their child. Excuse me. I'm so sorry. Darn allergies. So my battle cry is shield your nest egg. Get an LLC in any of the above referenced cases. Now, taxation of LLCs and why it matters. So there's not much of an analysis if you're a single member LLC. And that includes not just one person, but husband and wife. They are considered to be a single member in community property states. And most relevantly, obviously, California. So there's no separate return. On the right, you can see that all of the income and taxation passes through from the LLC to the single members. So it's easy, no additional tax preparer cost or fee. And everything's just reported on a schedule to your 1040 and 540 returns. Now, I'm just throwing in consulting work here again for the reason that if you use the sub S corp taxation, you can save all of the 15% tax on self-employment. And then the default for a multi-member LLC is to be taxed as a partnership. And that is simply wonderful because partnership tax, complicated though it is, for your tax preparer has great provisions with regard to real property in particular. There's no gain or loss on distribution of property to or from the entity. And you can allocate income and expenses to partners disproportionately if you meet certain tax rules. So it's very, very good as a taxation method, though not good as an original formation method. And I hope that's clear. It's best to form as an LLC and then be taxed as a partnership. And I'm throwing out a longer term benefit of LLCs. An LLC can, if you gift some of the interests to a child, the beneficiary, the child, can take some of your taxes, maybe at a lower rate. And of course, they take the rental income also, or the other income. And LLC interests have a great ability to be considered for gift and estate tax purposes to be worth a discounted amount. That's beyond the scope of today's webinar, but we can talk more about that in person or by Zoom. This is something that a lot of wealthier clients want to consider of gifting before the gift and estate tax exemption is cut in half at the end of next year. Now, back to earlier webinars discussion of Prop 19, the sneaky legislation which the promoters said was only going to affect wealthy trust fund babies and East Coast investors. Well, not so much. It affects all of us. So this is a refresher. Section 1, the good. Seniors can move their home's low tax base to a higher value replacement cost, up to 3 times in their lifetime. The bad is the worsening of the parent-child exclusion from reassessment on parent-child transfers, sadly. The parent's home is still protected on their death, though at a minimized amount, and other property no longer has a property tax exclusion when the parent gifts to the child. Now there is going to be a reassessment, unless perhaps Prop 19 is repealed in part, and Howard Jarvis is indefatigable in trying for that. So if you see opportunities to sign up for one of his petitions, I'd strongly recommend that. Though I don't promise success, still we can make our voice heard. So the restriction on a parent-child exclusion for the parent's primary home is that the child who receives the home, or perhaps children, that's less usual, that child must occupy the home as their primary residence. And the exclusion applies only to the first $1 million of assessed value, which is almost all of us. It used to apply regardless of the value of the home under Prop 13. So there is a workaround using Proposition 13. Oh, I misspoke. Sorry. Proposition 19. You can retain the current low assessed value when gifting LLC interests to descendants. So this is tricky, and I suggest that you have us do it for you, or at least guide you, but it's deed heavy, so you should have us do it. For any property, including your residence, perhaps, have us form an LLC before you buy a new property. So I know this is only forward-looking, but nevertheless, it's powerful. And it's easy, and the assessors know it now. So they're not, in my experience, they're not fighting it. So you've got now an existing LLC already formed that buys the new property. So then you, as owner of that property, take back all of the LLC interests, but you can gift some of them to your children or perhaps grandchildren. And there's going to be no reassessment so long as no one person or donee, in this case, receives over 50% of the LLC interests. This is especially worth considering when you've got a property that you hope at least will be kept in the family long term. We would love to help with that. So I gave one slide emphasis to the entity formation warning. Using the internet to form your LLC or other entity, for that matter, can result in, and often does, result in no protection at all, as well as penalties and interest on taxes. not paid. We've seen this to be true in practice with new clients time after time. So I hope you avoid it and let us help. So the new law, new-ish now, it's effective for transfers after 1/1/2024, is the Corporate Transparency Act. We're watching out for you. It is a law which gives more information now to the federal government. And it's hard to say that with a smile on your face. It requires entity owners to file identifying information, including copies of their driver's license, with the FinCEN agency, that is the Financial Crimes Enforcement Agency. This law could change, but we don't think it will. And we know some version of it will continue. So our very strong suggestion is that you file online. It's relatively easy, but we can do it for you because there are huge potential penalties if you miss the January 1st, 2025 deadline. So if you think it's something that you might not keep good track of, I see no reason for waiting till later in the year, and let us help now is my suggestion. It doesn't cost much, and get this off your radar in case it might possibly be off your radar, at the end of the year anyway. Now, for some practical case studies to bring the need for an LLC further home. Case number 1 deals with a drunken tenant who injures himself by falling through a stair railing on the second floor of a property where he has an apartment rented. The tenant's injured pretty seriously, files a lawsuit. The property owner is found at fault because they're the only ones shown in the public property records. No LLC was created, but it could have provided protection to the owner. Now we've got a intervening cause of injury in the form of the tenant's aggressive dog. The front door of the home somehow stopped latching properly. Excuse me. The tenant's dog escaped, ran blocks away, and bit a victim, causing injury. They filed a lawsuit. The landlord was found liable. No LLC was created. But I think it would likely have provided at least partial protection, probably full protection, because of the intervening facts that resulted in the injury. And finally, a slip and fall by someone on your rental property. So there's a properly formed and maintained LLC in place. A person slipped and fell on the property, incurring injury, and filed a lawsuit. Now, the great news, in court, the owner was removed as defendant because the LLC is shown in the property records as the only owner. And the LLC property was taken to, at least in part, pay the judgment. But the landlord's nest egg was not touched. So this is our goal for you. Beware of do-it-yourself. I hope you'll bear with me as I repeat one more time. Having a non-attorney form an LLC could result in no protection and penalties with the Secretary of State and interest owed to the Franchise Tax Board. You also need professional advice in maintaining the entity as well as creating it. We put that all in a wonderful closing letter that's at the front of your record book, so you can easily reference back to it. So just know the cheaper option of internet formation can cost lots more later. when your exposure, your risk is discovered in a lawsuit. So in conclusion, this is really not complete. I would say always consider an LLC for a rental property. That's pretty foundational. And in addition, always buy new property in an LLC because that actually gives you future gifting ability without a reassessment of otherwise major additional property tax when you gift or leave a property to a child in your estate. And there, that sentence refers to a non-primary residence property. Because I loved them, I put a little plug in here for charitable remainder trusts. I also draft irrevocable trusts of various kinds. But this one is the granddaddy of tax benefits. If you end up having one day a highly appreciated property that you don't need anymore, and if you have charitable intent toward a church or charity and like big tax benefits, like charitable donation deductions and paying capital gains tax rates, low rates, sometimes as low as 0, when you receive a lifetime income stream, schedule with me to talk about this. So that's my presentation specifically today. I want to talk up our firm because we're awesome. We have many years of doing what we do. We've been open since 1979. We have 8 full-time attorneys, 2 attorneys of counsel, and a CPA, which happens to be me. We have over 350, and this needs to be updated, years of combined attorney experience. We have many advanced tax degrees, including me, and certified specialists in probate, estate planning, and trust law. We have 45 plus highly qualified support staff. We have diverse staff, wide range of diversity, I'm proud to say. And they have very diverse skills. And they're very skilled at what they do. And then we have the 8 office locations and a broad willingness to meet with you via Zoom, if that's best for you. So I need to warn you, you're going to receive an automated phone call asking if you're interested in setting up any kind of appointment. So look for that. And we're here to help you. Our phone number is here, 800-244-8814, or visit our website, Copenbarger.com. Email us, info@Copenbarger.com. And know that there's a link in the chat for you to evaluate this webinar. So we'd really appreciate your doing that so I can improve my skills next time. And not just skills, it has also to do with substantive law that you'd like to hear more about. So I would like to say thank you so very much for participating today with us. And I pray no rain reaches you this weekend, and have a fabulous day. Bye now.